Melissa Galasso, and welcome to the Genuine Learning Blog. Today we're going to talk about a proposed ASU related to simplifying accounting for income taxes. So income tax accounting can be very difficult because there are differences between book accounting and the actual tax return. Today we're going to look at a couple of niche areas that are getting an update as part of the overall Simplification Initiative. So here's a little bit of background. So proposed ASU 2019-700 was issued on May 14, 2019, and comments are due June 28. So again, a very short period of time. This is part of the Simplification Initiative. So as indicated, the goal here is not to make things more difficult. It's actually to take things that were identified as being difficult and actually make them easier. So this is focusing on looking at a lot of the exceptions that currently exist in Topic 740 and trying to streamline and standardize so that we don't have so many exceptions to the rule. Anytime I teach accounting, I always talk about, okay, the rule is, and then it's going to be followed by, and the exception is. So in this scenario, we're trying to get rid of some of these exceptions to make things a little bit more standard. So what are some of the exceptions being removed? Well, first off, the exception to the incremental approach for intra-period tax allocation, where there's a loss from continuing operations and income or a gain from other income, for example, discontinued operations. So currently there is the exception to the incremental approach that is to be considered in determining the amount of tax that results from the loss from continuing operations and how that's going to go through. They are deleting that current exception to the incremental approach and making sure that everything is consistent. In addition, the exception to the requirement to recognize a deferred tax liability for equity method investments when a foreign subsidiary becomes an equity method investment. So that also is a current exception that's being removed. And then the exception to the ability to not to recognize a deferred tax asset for a foreign sub when a foreign sub equity method investment becomes a subsidiary. And then exception to the general methodology for calculating income taxes in an interim period when a year-to-date loss exceeds the anticipated loss for the year. That was basically an additional limitation that's being adjusted. In terms of the scope of Topic 740, there's confusion always between franchise taxes and income taxes. And so when we look at the scope here, it requires an entity recognize a franchise tax or similar tax that is partially based on income in accordance with ASC 740 and account for any incremental amount incurred as a non-income based tax. So one of the things that we typically see here is when we're looking at the scope. And so if there is an additional tax based on income, the excess is considered an income tax and is subject to this guidance. So when we're looking at scoping for Topic 740, one of the things that we're really driving here is trying to have just consistent treatment of these taxes. And then when we deal with business combinations, in the past, when we were dealing with them, one of the things was in situations in which the tax step up, the tax basis step up to goodwill was previously not deductible, then no deferred tax assets would be recorded for the increase in the basis except to the extent that newly deductible goodwill exceeds the remaining balance. Under the new standard, it requires an entity evaluate when a step up in the tax basis of goodwill should be considered part of the business combination in which book goodwill was originally recognized, and when it should be considered a separate tax, separate transaction. So again, trying to alleviate some of the confusion in that area. In addition, currently the standard is silent regarding allocation of consolidated tax expense to separate financial statements of members. So in this scenario, it states that an entity is not required to allocate the consolidated amount of current and deferred tax expense to a legal entity that is not subject to tax in separate financial statements, but then an entity may elect to do so for a legal entity that is disregarded by the taxing authority. So remember, not all entities are taxed. Some of them are what we call pass-through entities. And so if you are doing an allocation, it's going to basically allow you not to allocate any amount to something that does not pay taxes, but you can elect to do so if you want to. So they give you an option there. And then the last updates here, it requires an entity to reflect the effect of an enacted change in tax law or rates in the annual effective rate computation in the interim period that includes the enactment date. And there were some minor updates to income taxes related to ESOPs and investments in qualified affordable housing projects accounted for using the equity method. So again, lots of little areas within taxation, hopefully making things simpler. So again, we have some time before we are required to respond to this, or I guess you're never required to respond to it until you have the opportunity to respond to it. So if this is something that interests you, I encourage you to let the FASB know what you think of some of this proposal. So that's it today for the Genuine Learning blog. I hope to see you on a future blog. Have a great day, guys. Bye-bye.